Karara Capital is a Melbourne-based boutique fund manager. We specialise in Australian equities. We were established in 2007 and we currently manage over $3.5 billion. The business is well resourced, so we have a staff of 13, of which 9 are investment staff. Each staff member has equity in the business and the business is owned by the staff, so there's no external shareholders in the business. Karara has an agreement with Ironbark for Ironbark to distribute our product in the Australian market. The benefit to Karara is that we keep our business simple, focused, and therefore we can concentrate on investing. The investment team is strongly aligned with investors. As I mentioned previously, all staff have equity in the business. Also, each staff member has investments in our products as well, and also the remuneration of staff is aligned to the performance of the funds. The objective of the fund is to outperform the S&P ASX 300 accumulation index before fees over rolling 4-year periods. By style agnostic, we mean that there's no inherent biases to our investment approach. This means we're not overly biased to invest in companies with value characteristics, or those companies that have high growth, or large caps or small caps. This means that we have the whole investment universe to invest in, and we're really investing based on the investment merits of the individual companies. The benefit of this is that we're in the position to deliver consistent returns through an investment cycle. Look, to outperform the market, I do think we need to be thinking things and doing things different than the average investor. So our point of difference resides in, I think, 3 key issues. The first one is the perspective that we take. The second one is the temperament that we look to foster. And the third one is the disciplines that we apply. In terms of the perspective we take, I think we are broader and more forward-looking than perhaps some others in the market. By broader, I mean when we're analysing companies, not only are we interested in the stock-specific factors, but we're also interested in the broader operating environment and how that might impact the industry and also the company. In terms of being more forward-looking, I think we do take a longer-term perspective than perhaps others do, because what we're trying to do is cut through the noise and emotion that drives mispricing within the market. Look, in terms of temperament, what we're trying to do is foster a calm, patient, unemotional temperament. That really gives us a position to exploit the waves of emotion, that fear, greed, short-termism that often sweeps through the market. Look, in terms of discipline, we are disciplined in how we analyse companies. We look to be rational and independent in that analysis. So we're not getting caught up in the narrative of the market at any point in time. The second element is we're very aware of the price we pay for a company versus the value that we're acquiring when we buy that company, because ultimately that will be a key driver to the returns that we generate for our customers. We select stocks by answering 3 questions. The first question: is this a quality company? Does it have the characteristics to generate attractive returns over time for investors? The second question is the market missing something in its assessment of the company? Do we have some point of difference or some insight into the company, be it its earnings profile, its risk, its longer-term outlook? And the final question: as a consequence of all of that, based on our assessment, is the company being mispriced or not? Is the share price too high or too low? And therefore, is there an investment opportunity in this company? There's a couple of different ways how we manage risk within the portfolio. The first one is to really understand what we're buying, so to understand the company, so there's no surprises when we buy a company. The second one is to don't overpay. So if you pay too much for the stock in the first place, it's likely you're going to lose money over time. And the third one is the concentration risks. So ensure they've got the appropriate level of diversity in the portfolio. There's more than one idea, there's more than one company. So if one idea doesn't work, there's a number of others that will offset that within the portfolio. This is an equity portfolio, so it is exposed to the market and will fluctuate with the market. But to the extent that we can hold up to 10% cash within the portfolio, we can manage that market risk to some extent. But ultimately, this is an investment in Australian equities, and as the equity market fluctuates, this fund will also fluctuate with the market. Given the inherent volatility in equity markets, the recommended time frame for this product is in excess of 5 years. One, it should fit within a diversified portfolio, so making sure there's other different asset classes you're investing in. I think the second point is that given the points of difference I went through earlier, our fund does complement a range of other fund managers, so we generate returns somewhat different than other managers. So there is a diversification benefit that we provide versus a range of other Australian fund managers.